about a year ago with the center, and I'm the chair of the center, and along with Rob Valero, we are trying to provide programming for both our students, but also our alumni and other real estate professionals that are our friends. So what we came up with was a series. This is the first of three. So today we're going to be exploring REITs, what's hot and maybe what's not about REITs. And of course, as Rodney mentioned, Rodney Lake, our moderator, teaches a REITs course, and our students, all of them, fight to get into it. It's taught once a year. It's taught in the fall. And so we decided this would be a nice thing to have in the spring to get students interested in learning more about REITs and potentially take that class. In addition, of course, as you know, Rodney's program has three other funds that they also manage, three other classes. And so we are very indebted to Rodney for taking the time to continue working with this REIT class, because, I don't know if you noticed, his title has changed and he is now the Associate Dean for Undergraduate Studies. So congratulations, Rodney. We're very fortunate to have you in that leadership role here at GW. Additionally, as you might see, or you probably don't know, we have all sorts of varied people in this Zoom room. We have students from many of the real estate classes, but we also have a lot of our alumni and friends. So hopefully at some point we will be able to do our Think Tank Thursdays in person, but we're going to stay virtual this semester. With that, I'm going to turn it over to Rodney and he will begin the panel. And then we have a surprise at the end. So don't go away and stick around till the very end and you'll get a surprise. So with that, Rodney, it's all yours.
Thank you, Dr. Warzala. Very much appreciated. Love the cliffhanger. So thanks for mentioning that. I think that's always good to keep everybody in their seats. So, and on the edge of them. As mentioned, my name is Rodney Lake, Vice Dean for Undergraduate Programs, Director of the GW Investment Institute, and faculty in the Finance Department. You're not here to see me, you're here to see our panelists. And so I'm just gonna give their names, and then I'm gonna ask each of them to take a few minutes to give their personal introductions. We'll get into your companies after that. So for the first 2 to 3 minutes, give your introductions, but I'll just introduce them by name and then we'll go in that order. So it'll be Lori, Jeff, and Brad. But first up is Lori Baker, who's Executive Vice President and Chief Operating Officer for Camden Property Trust. Ticker is CPT. Next will be Jeff Berkes, President and Chief Operating Officer, two COOs today at Federal Realty Investment Trust, ticker FRT. And Brad Thomas, CEO of Wide Mode Research, Senior Analyst at iREIT, and the author of the Intelligent REIT Guide, How to Build Wealth with Real Estate Investment Trust, obviously super relevant for us here. So if we could kick it off over to you, Lori, a brief personal introduction. So, what's your current role, background, and your connection to GW, and we'll get into your company after that.
All right, well, it's a pleasure and an honor to be here at your inaugural event. Thank you so much. My name is Lori Baker. As Rodney stated, I graduated from GW in 1990. It just kind of seems like so long ago, with my MBA in finance. I have been with Camden for 23 years, but I have recently been promoted to the COO position. So thank you, Rodney, for the congrats earlier, and thrilled to have this opportunity to lead such an amazing organization. It does not seem like I've been at Camden for 23 years because it's always something new and interesting and exciting, and just a fabulous culture and workplace. We are a multifamily REIT. We have apartment homes across the US. I call it the smile of the US, or predominantly the Sun Belt markets. Headquartered in Houston. It's about 58,000 apartment homes, and looking forward to this conversation.
Thank you, Lori Baker. So Jeff Berkes, over to you next.
This is going to sound strikingly similar.
We're old timers at our companies.
That's right. My LinkedIn profile says I've been at Federal Realty for 25 years, but I've worked 2 stints and I missed about 1.5 years. So I've been at Federal for 23 years. Like Lori, I was promoted about 1 year ago to my current role, President and Chief Operating Officer. Thank you. And I came up in the business through the investment side. I started at Federal in 1997. I graduated from GW's graduate program in 1993, living in DC, joined Federal a few years after that. But I started on the investment side of the business as an acquisitions person, became chief investment officer, moved to California 18 years ago, where we've got about a third of our company, and then took on an operating role out here 9 or 10 years ago. And then, like I said a few minutes ago, got promoted a year ago to president and COO for the whole company. I'm now officially bi-coastal. I spend 2 months every quarter in California, and then 1 month a quarter living in Bethesda, Maryland, across the street from our Bethesda Row property, and working with our East Coast team, and doing all my East Coast business during that month. So really happy to be here today. Rob, thanks for asking me to do it. And now that set up and functioning in DC, looking forward to reestablishing my connection with GW. So again, thanks. Pleasure to be here today.
Thank you, Jeff, and congratulations on the promotion recently as well. And thanks for making time for the panel. Next up, Brad Thomas, over to you.
Great. Well, it's great to be here for this inaugural event. I am not an alum, so I guess I'm one of the minorities in the group, but it's great to be on this panel. I'm certainly familiar with both companies here, Federal and Camden. We cover both of those companies. I guess I'll go ahead and put my disclaimer out. I'm a shareholder in Federal, not yet Lori in Camden. I hate to disappoint, but I am in Federal, have been a while. But these are two dividend stalwarts. Obviously, we got a dividend king at Federal Realty, and Camden has an amazing track record for dividend growth as well. So really great to have you both on. Real quickly, I was a developer for about 25 years. In 2009, I had a change in career. I wanted to focus on kind of pivot from real property to intellectual property. And I became a research analyst covering the REIT sector. We've now, over the last 10 years, built a pretty nice business. We cover REITs, but it's kind of my focus. But we also cover a lot of income alternatives, which include BDCs and master limited partnerships and other dividend paying companies, other dividend kings like Federal. So it's great to be on this panel and with such great experts and great companies. So thank you very much again.
Thank you, Brad, and thank you for making time for the panel too. Looking forward to hearing your thoughts on the REITs overall from the investment point of view. Very much appreciated. So back to you now, Lori, and we'll kind of keep this order throughout the panel to try to keep it easy for everybody. And we'll have a couple of jump balls maybe here and there, but back to you, Lori. Now dive in a little bit on Camden Properties and just give us a brief overview of the company and the strategy. You gave us a little bit a teaser there at the beginning, but maybe dive in a little deeper. And for the people that don't know much about it, give them a more than a introduction. So over to you.
Sure. So I think I probably should start out diving a little deeper in just those markets. I mean, what we've all seen across the US this last 24 months and really in the last 6 months of the year, housing is just a need that we have across many of our markets, whether it's single family housing, single family rentals, apartment housing. Housing stock is low and there is so much demand and not enough supply. So that bodes well for our business. And, I don't know for the people in the room, a little background is Camden went public in 1993 when a lot of the apartment REITs were going public. And, for 28 plus years now, getting ready to be 29 years, we've done incredibly well over that time frame. But by far, this past year was the best year our company had ever experienced. Our original founders who started the company, Rick Campo and Keith Oden, thus the name Camden. It's not named after Camden, New Jersey. It's their two last names joined together, have said, at recent meetings that they've never seen a time like this. And it's just one of, the shortage, the demand, the need for people to have housing, the need for people to work from their homes. There's just so much of the there's not enough stock out there. So because of that, in the markets we're in, which are the Sun Belt markets primarily, and we start in kind of LA down to San Diego, across to Denver, Arizona, Phoenix markets, all hot markets. Texas, Austin's growing. That's a big market for us. Houston, obviously, in our backyard, Dallas, and then across to the Atlanta, South Florida, again, and then and going up the East Coast to North Carolina markets in the DC metro. That's just where a lot of the migration has been happening, and house migration from across the country, as people were able to live anywhere they wanted to and work remote in warmer climates, and just pro-business, and a lot of good things happening with job growth. So our long-term strategy is really focused and has a commitment to high growth markets, population, growth areas, and migration. So that's both well for us in this last cycle. It's not always been that way. There's been, the high barrier markets, the coastal markets, a lot of favor has been in the past, and we've kind of had to continue to share our story and why we like the markets we're in, and it's just played out very nicely for us during this last 2 years that we've experienced kind of this pandemic and the migration. We had, with that great performance, I will, because we are publicly traded, we give guidance, we have our budgets, and last year going into 2021, we were struggling to figure out what that might even look like, but based on our guidance, we outperformed that by 40 million, and our total shareholder return was 82% last year. So just an amazing kind of year during some really tough times to operate our business. So we're operating apartments during COVID when our frontline employees had to be in the office every single day to serve our residents as well as customers coming in, was a lot. And especially when they're spending most of the time in those apartments using all of our amenities and spaces, when we sometimes then also had to then turn on a dime and lock those spaces up and provide services differently. So we can talk a little bit more about some of that and the pivot we had to make, and just rewriting our entire playbook overnight, like everyone was forced to do. And I think all of our industries did very well in doing that. But we operate, a diverse portfolio in the sense we have good geographical diversification. We have A and B product, and urban and suburban. So sometimes one over the other is in favor. Right now, suburban has performed better than urban because nobody's spending as much time, or things are changing. It's good to see activity again in our downtown urban core areas, but our suburbans really performed well in the last 12 months. We recycle capital through acquisitions and dispositions. We create value through our developments. We're constantly repositioning properties to make them look new again and compete against the new products showing up across the street from us. And we make investments in technology. And then kind of our story, which puts us as kind of one of the best balance sheets in REIT land, is that we are very focused on a strong balance sheet with ample liquidity. We've got right now about 1.4 billion in liquidity. That's comprised about 500 million in cash and about 900 million in our unsecured credit facility that we haven't even tapped. So we're well positioned to capitalize on opportunities. I will share just one last note is, during the last kind of Great Recession financial crisis, Camden experienced a period of time that we kind of got spooked by what was happening across the markets, and feeling like if we would have had a little bit stronger balance sheet and a little more liquidity, we could have taken advantage of more opportunities. And we made a commitment at that time that we would, weather any storm in the future. We would keep our debt to EBITDA in the 4 to 5% range, but if in good times, 4%, but has served us well. And we're right now at a 3.8. So if the market were to turn, and current circumstances, even this morning, but turning on the news and seeing what's happening, you just never know. And we could easily we would be in a great position. So if anybody is invested in our stock, GW students and the Institute, we should be weathering these storms, whatever it may be, very well.
Thanks, Lori. And I'm going to ask each panelist a follow-up question after they introduce their company. So it'll go to you, Lori, first. But I will mention first that one component of our framework is balance sheet. So business management, price valuation, and balance sheet. So one of the sorting criteria that we do, and one of the reasons that students initially found Camden was this focus on the balance sheet and, always being prepared for a bear market. And that's something that our framework sorts for. So thanks for that. And thanks for staying true to that. Follow-up question, and I'll have some others put a pin in the technology piece. I want to come back to that, but maybe without speaking specifics, and I know given it's a public company, there's only so much you can say on these things, but, do you think that, demand has been brought forward, or do you think it's going to be a shift, that the mix that Camden has to offer is really just a fundamental shift in the demand for customers, meaning people moving to the South right now, to the Smile? Do you think that trend will continue? And do you think this suburban urban will continue, or do you think it will start to sort of reach some type of equilibrium where people move back into the urban areas?
That's a question we've continued to ask ourselves. I mean, there was already migration trends happening pre-pandemic. So I think, it just got exacerbated when people could live anywhere they wanted to, and they were trying to lower their cost of living. I think that, that definitely was what was happening in New York and San Francisco and some of these, more expensive markets. I think people will ultimately get back to some of those markets. And I think that at the same time, if you have the thesis that you're in high population growth areas, where jobs are created, where there is the inward migration, as well as people coming from outside of the country, even though we haven't seen as much of that. We like our markets. That's why we're there. But I think the pendulum may have swung a little bit more, and the suburban, people keep going further and further out. If there's a day that people do have to come back into the office, which I don't know if that's ever, I think the genie's out of the bottle. It's not going to change, but there'll be hybrid environments very similar to what we do now, 3 days a week in the office. People still have to commute in at times, and how much pain do they want to endure into doing that? So, we think that our urban areas will come back a little stronger. We're seeing the activity, and we think that's happening because restaurants are opening again. People are spending time getting out again, and it may not be just the drivers of office buildings, but just what's happening in those urban centers. But right now, our occupancy on our suburban still a little higher than what we're seeing in our urban markets.
Great. Thanks. That's fantastic market information. Thank you very much, Lori. Great to hear it from you as well. So we're going to move on now to Jeff. And Jeff, please, company overview and the strategy. And as Brad had already mentioned, high dividend paying company, federal in the retail space with a great track record. But maybe give a little bit more to the crowd around the strategy and overview for FRT.
Sure. Happy to do it. So Federal's been around now for 60 years. We were actually founded in Washington, D.C., and the D.C. area remains our largest market. We own 104 properties. We're only in a few markets: Boston, New York, Philadelphia, D.C., South Florida, the Bay Area, Southern California, and then last year we got into Phoenix, which has really become just an extension of Southern California in many respects. We own about 25 million square feet of property. Very, very diverse tenancy. We have 3,100 different tenants in our company. The largest tenant in our company pays less than 3% of our base rent, only 2.7% of our base rent. And we really we focus on two types of real estate product. And I'll come back to why this is important in the REIT world. We focus on high quality open air retail properties and open air mixed use properties. And that's an important distinction in our business. Federal is format agnostic when it comes to open air retail. But when we get classified by the analysts that follow our companies and the investors that invest in our companies, there's really two groups in our business. One is enclosed malls and the other is open air. So we are not an enclosed mall company. That's the only type of retail product we don't invest in. And a lot of our peers within the open air business have a very specific format strategy, meaning they only acquire shopping centers anchored by the number one or number two grocer in a market, or they only acquire power centers. We have always remembered that the first two words in REIT are real estate, and we're more about the real estate. We like buying a location and then over time making sure the improvements that are on the real estate satisfy the demand in the market and connect with the community. And we think that's the best way long term to generate value and earnings growth and dividend growth. Right now, when you look at the company, roughly 65% of our revenue comes from neighborhood, community, and power open air centers. The other 35% comes from mixed use properties. And from a product type standpoint, 80% of the revenue at Federal, maybe just a little bit less, is from retail space. So, think of places that you would go shopping or go out to eat or maybe get your haircut, work out, something like that. That's roughly 80% of the rent payers within Federal. And then about 10% of our revenue comes from Class A office and another 10% from multifamily residential. We own 3,400 residential units, primarily located in our mixed use properties. Our strategy is to continue to grow in the markets that we're in, and also to, over time, add value to and densify the existing real estate that we own, by changing shopping centers that are generally built at a 0.25 to 0.3 FAR into more dense uses of the land. The best example locally for all of you on the call that are in the DC area, this recent is our Pike and Rose property up in North Bethesda. So that's a property that we've controlled since 1987. 20 years after gaining control of it in 2007, roughly, we were able to negotiate an acquisition of the land. We owned that property under a long-term ground lease. We bought the land, and then we went through a re-entitlement process that allowed us to build roughly 3 million square feet on a piece of land that prior to the entitlement effort had a 300,000 square foot shopping center. And then we started tearing down the shopping center and building Pike and Rose, and we built back roughly 300,000 square feet of retail space. But we've also added a hotel, condos, 3 different residential rental products, Class A office, and we actually just entitled a site there for a life sciences building. We have a car dealership, a Porsche dealership on the site as well. So that's what we do. That's our strategy. We buy great real estate, hold it forever, and add value to it over time through densification. Similar to Lori's company, we are very, very focused on having a simple corporate structure and a very clean and conservative balance sheet. Federal's worth, well, a little bit less today because of what's going on in Ukraine, but Federal's roughly, $13 to $14 billion company, total market cap. $4 billion of that is debt. So, we're, depending on where the equity is trading, somewhere between 25 and 30% levered. We have an A- rating on our debt from Standard & Poor's. We're one of the few REITs in the REIT universe to have an A rating. And like Brad alluded to earlier, we're a dividend king, which means we have increased our dividend every year for 54 years, which is the longest in the REIT industry. And part of our strategy, of course, is keeping that balance sheet clean and keeping that dividend growth record intact. In fact, in our sector, we were only one of 2 companies that continued to pay and increase their dividend during the pandemic. And if you dial back to the great financial crisis, we were one of the very few companies in all of the REIT domain to not only continue to pay our dividend, but to pay it in cash as opposed to shares. Many REITs during the downturn stopped paying a dividend altogether, and some of those continued to paid in shares, not in cash. We were able to do that because, like Camden, we're very conservative in the way we manage our balance sheet. We know that we're in a cyclical business. There's ups and downs always, and a lot of the downs, like things that are happening this week, you can't really predict, but you got to be prepared for. And for us, running the company and running the balance sheet that way over the long term has paid off, and it's allowed us to take advantage of opportunities when others couldn't. So that's a big part of our strategy. Growing earnings per share and growing the dividend come out of that. And another big focus at Federal that's getting a lot of attention right now, although it's something we think we've been doing, for at least the 2+ decades that I've been here, is we want to be a great place to work, and we want to be a great place to work for everybody. So it's been very important for us for a long time to focus on our employees, regardless of where they came from or what religion they believe in or their sex or skin color. And you can see that on our board of directors. You can see that within our company. And we think talent is important, and we always want to be the place that people want to come and work and learn and grow in their careers. So that's a big part of our strategy as well.
Thanks, Jeff. One follow-up question for you here, and we're going to come back to some of the mixed use category in a moment. Open air obviously seems much like a great idea during COVID. What has been your experience through COVID? Did you get an influx of customers, or some other version? It would seem like you had in some ways benefited from people thinking, I need to be outside more. I want to have these options. Was that a net benefit during COVID? And then what's the outlook moving forward?
Yeah, I'll try and keep that short, Rodney, because we could occupy the next one of these with what we went through during COVID. But I think that, a couple of big takeaways. One is, I think the importance of a physical location became very, very evident through COVID, not only to merchants, not only to the retailer, but also to the consumer. And it became hugely important to the retailer because a physical location is the most efficient way to distribute goods. We quickly converted all of our properties to have curbside pickup. And a lot of the bigger retailers, think of Walmart, Target, that ilk, did a lot of business with buy online, pick up in store, which was hugely important during the pandemic. Many of the big conventional grocers did that as well. And then, the other thing that wasn't immediately evident at the beginning of COVID, but, as restrictions started to lift and people got tired of being in their homes, staring at a computer all day and, dealing with kids and dogs and all that kind of stuff. A place to go and start to socialize again and start to feel like part of a community, hugely important. And then obviously, being open air versus enclosed was a big advantage during COVID. And we, for a long time, have been very focused at Federal on what's referred to in our business as placemaking. So that's, having parks and wide sidewalks and streets where the restaurants can spill outside and, serve customers out of doors. And we were very, very focused on making sure that everybody took good advantage of that. In fact, at a lot of our mixed use properties, Santana Row, for example, we spent several $100,000 buying tents, heaters, lights, so we could help our merchants expand outdoors in a safe and also consistent way. So it looked good for the consumer and it was functional for the consumer when they decided it was okay to leave their house again. So a lot of great lessons learned during COVID, and the shift from the center city to the suburbs. We are primarily a first ring suburb company, and the amount of leasing that we've done, which we'll get into later in the talk, but the amount of leasing that we've done has been huge, and a big chunk of it driven by businesses that were formerly, hey, we're only an urban company, we're only a central business district restaurateur, picking up their head, looking around, realizing nobody's coming to the central business district anymore. And as great of a chef that they have and as great a concept as they have, they need to be where the people are, which is the first ring suburb. So we saw a lot of demand from restaurants coming out into the suburbs, a lot of demand from businesses that did not have legacy balance sheet issues, that saw COVID as an opportunity to upgrade their real estate, and a lot of new brands, which we tend to refer to in our company as new to market type tenants that maybe had always been digitally native, or maybe they just had a few stores and saw it was a good time to expand, coming to our properties. So I think COVID and the pandemic in a lot of respects have been a game changer and very good for the open air business. Certainly a tough time, the first 12 or 18 months, working with all the tenants on, how are they going to pay rent, and how are they going to survive, and all that kind of thing. And our philosophy on that is, if you're a good merchant, if you're open, honest, and transparent with us, we're going to help you, because we know this is going to be over. And when it's over, we want our properties to be in good condition, and we want businesses that are good businesses to remain open, not closed. So it wasn't easy, and it wasn't all good. A lot of tough decisions and hard things for our people to work through, like Lori alluded to. But I think we came out of it as well as we possibly could have, and learned a lot.
Excellent. Thanks, Jeff. And I think we have a question from the audience. Elaine has agreed to manage the question. So Elaine, over to you.
I am commanding the questions, and we do have a couple questions actually for you, Jeff. The first one, are you finding medical tenants are a common tenant that you are finding entering some of the retail space that people have moved out of?
Yeah, that's been going on for a while. That started pre-COVID. For sure. But there has been more, I'd use a broader term than medical. I call it health and wellness. A very broad move by health and wellness businesses to expand in this country, given the aging population, and, focus on taking better care of yourself. So, whether it's true medical use or something that's maybe a little bit broader, there's been a lot of demand for that, and that's been building over the last 10 years probably.
Mm-hmm. Great. That's a fantastic answer. Michael has a question about California, New York versus Florida. Did you notice a large performance difference between those areas with different protocols?
Well, yeah, I mean, look at, we had the, what do I call it, the distinct benefit of being in Massachusetts, New York, Maryland, and California, with about 85% of our portfolio, which were the 4 most restrictive states during COVID. So working through that was challenging, and certainly the beginning, when everybody was really locked down in those states versus other states, was difficult. Once the vaccine rolled out and mask mandates started to lift and things eased up, I think those markets caught up very quickly. We do not own a large portfolio in South Florida. It's relatively small, so it's hard for me to compare directly what was happening. But certainly when you don't have restrictions in Florida or Texas or some of the other states that didn't, if you're in the retail business or the movie theater business or the gym business, you're at a disadvantage. Mm-hmm. But with the vaccine and, getting through Delta and now getting through Omicron, those other markets have snapped back very quickly. Our portfolio is very well leased right now. So, excuse me. And demand for space has stayed consistently strong, for the last 18 months or so for us, regardless of location. So it's more about, how the retailers and restaurants have had to deal with the restrictions on the ground floor than demand for space. Demand for space has been strong.
Okay, great. We have a couple more questions, but why don't we let Brad go and then we'll come back to the questions.
Yep. So Brad, over to you here. So first, please talk about Wide Moat Research, your work at iREIT, and then further introduce the Intelligent REIT Investor, please.
Great. Well, again, thank you, everyone. And it's really hard to fill these shoes. I want to say something. I was, first off, I haven't written on Camden since 2012, so I definitely need to do that. We've written on Camden, but not kind of what we call a deep dive. But I was looking at Federal, and I want to give you some headlines. I wrote recently on Federal. The title to the article was "Federal Realty, a Dividend Dream King." The next one I wrote was called "Federal Realty, the One and Only Dividend King in REITdom." Then Monopoly Man lands on Federal Realty, or is it Boardwalk? And then Federal Realty is the king of the castle. And I could go on and on. So I guess the point of that is it's important to understand, and this is what we really preach and teach to our investors and students as well, is that dividend growth is really essential, not only in the REIT space, but just in any stock that you're buying, really looking at that dividend growth. And we spend a lot of time at Wide Moat looking at fundamentals. That's really our business model, is fundamental analysis. There's a quote that I want to give you real quick, and this kind of goes back to that Dividend King record. This is Benjamin Graham, and by the way, my book was purposely titled "The Intelligent REIT Investor." It's play on words because Ben Graham wrote "The Intelligent Investor," who hopefully all of you have read. I make all of my kids read. I've got 5 kids, and hopefully the older ones are going to read it if they haven't yet. But this is a Ben Graham quote: "One of the most persuasive tests of high quality is an uninterrupted record of dividend payments for the last 20 years or more. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test." So dividend quality is really essential. And what we'll do at Wide Moat, again, in the REIT space, but also we have about 500 individual stocks kind of in our overall coverage spectrum, of which 150 of these are equity REITs. We also cover the commercial mortgage REITs, not the residential, but the commercial mortgage REITs, which are primarily backed by private equity firms like Starwood, Blackstone, TPG, et cetera. But within the equity space, that's what we cover. And we put quality ratings on each of these REITs, each of these individual REITs. And we put value ratings, again, recognizing that quality and value are really the essential ingredients to deliver, outperform. Not only in REITs, but outside of REITs as well. So that's really a little bit about what we do at Wide Moat. We're a publishing firm. We provide publishing research products to both individual investors and all the way up to family offices and institutional clients as well. So again, we're growing. This is the REIT space. I'm glad all of you are watching this because you've got some really these REITs here, Federal and Camden, they both have A-rated balance sheets. I was looking when Lori was talking and Jeff was talking, I was looking at kind of our scoring model for these companies, and they score extremely high on quality. Obviously, these A-rated balance sheets, you can see the impressive cost of capital that they have to deliver very meaningful and very powerful earnings growth. Of course, FFO is the earnings metric we use in the REIT space. So hopefully that answers that question, Rodney. And again, I'm happy to answer any questions at all.
Great follow-up question here. So thanks for doing that. And you mentioned the book, The Intelligent REIT Investor, and we use The Intelligent Investor for all of our investing classes. And so we make that a must read. Maybe you could give, 1, 2, 3, high level sorts, as you mentioned a couple of things, increasing dividends. But when you are, without giving away your scoring system, how do you compartmentalize the different components and how do you weight each one of those things? And again, without divulging anything that's the secret sauce, but from the investment standpoint, obviously we've mentioned the value of having a strong balance sheet because it provides the opportunity to be opportunistic. It provides the opportunity to live through tough times. What other factors are important and how do you rank them?
Yeah, so the dividend overall is weighted very highly, and everything is certainly correlated. So when you first start at the earnings growth, we look at the company's earnings history, so their FFO history, how they've performed over the last 5, 10, or even 15, 20 years, if not longer. That tells us how they've performed in multiple recessions. We can go back to 2009 or 10, for example. What's interesting in this last pandemic, and of course, this is the first pandemic for all of us on this call, We can see how now REITs have performed, and most of them have recovered extremely nicely. In fact, I was looking before this call, and I know Lori mentioned some statistics, but like Camden, if you'd have bought Camden, for example, in March of 2020, and if you would have been, bought right in the middle of fear, if you will, you would have delivered 137% total returns, or 56% on an annual basis. So very strong, and that acceleration is just going higher and higher. That's exactly what we look for. We look at companies like Camden. We look at that earnings growth profile, not only the historical earnings history of Camden, because Lori's right, they did learn a lesson from the pandemic. Now the company, in fact, you could argue that Camden is a REIT that actually prepared for the pandemic by deleveraging the company and making this a much stronger company moving in. Of course, nobody knew we were going to be entering a pandemic in 2015, 16, 17, but Camden is a great example of a company who really decided to risk manage and really protect that dividend, recognizing that dividend was the essential ingredient. One of the things I say a lot, I didn't create these words, but I've heard this from a friend a long time ago. The safest dividend is the one that's just been raised. And that's extremely, extremely important. That dividend growth is a signal to investors that the company's strong, and I'm going to reward you for being a shareholder in that company. And so it's very, very critical. Dividend growth I cannot stress the importance of that. But all these other factors, the balance sheet, for example, we put together, I've got a new study guide, by the way, going out here shortly, which is really for students, where you can go in and look at some of the items like weighted average cost of capital. That's the WACC, WACC. And I don't know if that's being taught yet in your course, but certainly weighted average cost of capital is extremely important. We look at this, real estate, REITs are really a spread investing business. So you're going to buy based on your equity cost, your debt cost, and then your cap rates, and then how much can they grow those rents. Obviously, in the case of multifamily, what Lori's company, Camden, has done is they've been able to accelerate that rental growth tremendously because of the supply and demand out there and the lack of product. So Camden's done a great job. Federal as well. I mean, nobody can even come close to a 50-year record. I didn't come on here to give a commercial for both of you, but these are just great textbook examples of companies that have delivered. But look at Federal and how they've been able to grow that dividend for 50 plus years in a row. So we look at all of those fundamentals, if you will, combined. It was balance sheet, liquidity, earnings, dividends. Now we also assess management. I want to say one last thing. Management, the reason my new book, the reason we include management, and actually I titled the last chapter, Management Matters. And we've got two excellent management teams again on this call, is because management's important for moving the needle. And we really assess the quality of that management team and how they allocate capital to transactions and manage that risk and help grow that dividend. So I think all of that collectively really goes into our scoring model. Valuation speaks for itself. Again, Ben Graham talks about Mr. Market, and Mr. Market is whatever that share price is. That's Mr. Market pricing that security every day, every 5 days a week. So we look at companies that maybe Mr. Market has not factored in. We like mispricing. We're value investors, so we look at companies. Right now, Federal's cheap. Camden's not. Would I buy Federal? We've got a buy recommendation on Federal because we believe it's trading at a fairly significant margin of safety. Camden, however, is not. Mr. Market really likes Lori's company and thinks a lot of it. And so, unfortunately, I can't buy Camden because I want to see a cheaper security, because I think that's how you improve your total return prospects.
Excellent. Thanks, Brad. Very insightful. Very much appreciated. So now we're going to go a little bit into the sector for each of our individual panelists. And as you mentioned, Brad, this is not a commercial for Camden or FRT, but it's not a coincidence in our view that they're both GW alums who are now chief operating officers. So, I don't want that to be lost here, but thanks for mentioning that, Brad.
Well, exactly. I'm sure they both made A's when they were in school, because they both have A-rated balance sheets.
Exactly. That's definitely the case.
Brad, I would have loved taking your class.
Yeah. So now let's go into the sectors. And then for you, Brad, I'll mention what that, the view there is. But for both of our COOs, first you, Lori, then Jeff, talk about your views for retail, talk about your views for apartments. And then for Brad, talk about the REIT landscape in general. Obviously, the REIT landscape has changed significantly from the investment standpoint from the 80s, 90s, and now it's a very different market. How are you seeing that evolve from your standpoint? So Lori, maybe kick it off first and see what's the sector view within residential and any insight you can provide there.
All right, thanks. Well, I'd like to start off real quick and just piggyback on something Brad said. And that's highlighting management platforms. I mean, you're investing in a stock, a REIT, because you're trusting people to manage that money well. And the management teams do matter, and it's important, and how they continue to harvest value and look for opportunities to invest their dollars within their own assets, as well as growing their asset pool. So I think that's really critical. And we don't do this without the magic of the people that are all on our communities across the country. We always say, the real assets are not the equipment out there that's our apartment buildings. It's the people that are managing them. So I think similar to what Jeff was talking about, we're proud of the fact that we've created a culture that people want to come work here, especially in this talent war. And it's still difficult, to get those people to realize the difference in the companies that are out there and where you can build a career and grow. I didn't stay at Camden for 23 years. Jeff, I'm sure, didn't stay at his job because you were sitting there doing the same job every day. It's because you've had growth opportunities and you've had the opportunity to contribute to something much bigger and be, a part of something exciting. So I share all that because it's so critical to what makes our company successful, because every day we have to be creative and innovate and think how we're going to compete in this marketplace. So with that, I can say, the fact that Camden has been 14 years straight on Fortune 100's best places to work and ranked number 8 last year is just a scorecard, so to speak. We don't go after trying to be the best place to work, just for the sake of getting on Fortune 100's list. It's the fact that they recognize the teams and our employees comment and fill out surveys saying that they enjoy working here. So with that kind of backdrop, having an incredible management platform and then taking advantage of what's happening right now in the marketplace, I remain very optimistic about the future of REITs in general, but obviously in particular the multifamily business. And if you look at, barring any significant deterioration, we have set the stage for another record year of growth in 2022. We're already, the leases that have been signed last year that are already in place, and the leases that were being signed, because obviously we can't talk outside of anything that we've just shared in our last earnings call. But our same store revenue guidance at the midpoint is 8 8.75, which is pretty darn strong. I mean, we used to celebrate getting 3% revenue growth, and some years you eke out close to double digits, but it's typically certain markets. I mean, across the board, if that's the midpoint, you've got some really high areas, and our growth is happening in Tampa and Phoenix, and we entered Nashville this year for the first time. That was the first time we've entered a new market in years, and so those are great stories to tell. Our NOI growth is forecast to be 12%. So again, just incredible opportunities given where we are with the fundamentals: tight vacancy, healthy job and household growth, accelerating wages to pay these rents that's happening out there, and above average pricing, power for Camden when your occupancy is sitting at 97.2%. I mean, those are super strong occupancies. When, if you look at compare, that was January of 2021, just a year ago, when we were still pretty, deep into the pandemic, we're at 95.7. So very, big movements there. Young adults are, currently number about 67 million, and will remain a kind of a steady source of demand in the near term. And there's still pent-up demand from young adults living at home with roommates. You have young adults making life decisions, later lifestyle decisions, in particular, like marrying later, having children later in life, delaying home ownership, which is even more of a challenge today with the cost of housing and buying that first home. We see that the overall apartment supply should remain elevated through 2023, but no cracks for now, as demand for housing is just outpacing the amount of available apartment homes. And apartment values have increased. Another like 3.5%, cap rates are down. And that is all because of just the strong, just the strong performance across the board and in most every market. And so, for that, I think it's going to be a really good year, and the prospects for the next couple of years, even if we get oversupply in certain markets, we're still going to be doing really well and above what is typically seen as the norm in revenue growth and occupancy.
Thanks, Dory. Thanks for that mini teach-in on multifamily. Very much appreciated. Jeff, over to you. So retail, if you read the headlines, I think of a Mark Twain quote that says something like, reports of my death were greatly exaggerated. You would have think no retail would have ever survived the last few years at all if you just read the headlines for retail. So maybe help demystify the headlines from what's the reality for retail now and moving forward.
Yeah, that's a good way to set it up. And I've touched on a little bit of this already, but I think retail has not only survived, it's actually prospered. And again, going back to what I said a few minutes ago, the importance of a physical store was borne out in many, many different ways during the pandemic. And like Lori, or really like anybody in real estate, we're in a supply and demand business, and simple supply and demand business that's difficult to execute might be the best way to put it. But if you go up to 30,000 feet, and if you in your classes get any analyst reports written on our sector, a lot of them are going to tell you that there hasn't been any new supply in our business for 15 years, and that's pretty accurate. There was a lot of retail space built in this country in the 80s and the 90s, and some would argue way too much, and I think they're right. There's a significant number of Class C and even some Class B malls that simply need to go away. But in the open air sector, it's especially the higher quality open air sector, which is generally what the REITs own. It's a very different story. Not only federal, but also our peers have had record leasing coming out of the pandemic. I mentioned earlier, we leased 2.9 million square feet last year, including some office space, which I'll talk about in a little bit, which was a banner year for us. The box space in the open air business is very well leased, upper 90% range, and small shop, where a lot of the mom and pop tenants are leasing space, and arguably the hardest hit during the leasing on the small shop space has come back very, very strong as well. And it's come back for us again. Not being format agnostic, we have a lot of different types of property in our portfolio, and the demand has been very even and very broad based. Whether that be some of our more expensive space at Bethesda Row or Pike and Rose or Santana Row, or some of the more community serving commodity type space like you might find in some of our centers along Rockville Pike, for example. Just exceptionally strong demand. In office, again, where we get 10% of our revenue, we had a very strong year last year for leasing. We delivered a new building at Pike and Rose, 212,000 square feet, and a new building up at our Assembly Row project, both of which opened during COVID, and both of those buildings are virtually 90% leased now. And within the rest of our space, within the company, we've seen strong demand for offices. And interestingly, companies that occupy office space have a challenge today. They have to convince or incentivize their people to come back to work. Well, one of the best ways to do that is to have office space in an office building that's brand new with a great HVAC system and virtually touchless elevator controls and all of that. And, to have that office space located in a fully amenitized environment where your employees can come either, public transportation or park their car and remain all day and have a multitude of places to grab a cup of coffee, lunch, options for entertainment, working out, dinner, whatever after work. That's what companies want today to help incentivize and convince their workforce to come back to work. So we've seen really, really strong demand for our new office buildings. And then like Lori, and again, coincidentally, our multifamily was 97.2% leased at the end of 21 as well. Again, simple supply demand equation, difficult to execute, but when you have good real estate and first ring suburbs of some of the better cities in this country, the demand is strong and relatively little, if no new supply is being built. So, it's a time for us to capitalize on that and, push our occupancies and rents up as best we can. And that's happening and has been happening now for the last 12, 18 months.
Thanks,
and
Jeff.
we think it'll happen going forward.
Excellent. A great overview there. Thanks for that. Over to you, Brad. So your sector in this case would be investing, and then specifically for this panel, investing in REITs. What's your view of how things have changed over the years? REITs are a more modern investment structure than overall. And then what's the outlook for REITs moving forward from the investment perspective?
Sure. Well, first off, I noticed, I think next month you're going to have the prop tech, class. And I was looking at your next panel. I'm going to try to listen in on that. We actually started covering prop tech because a lot of these REITs, from Essex, I'm sure Camden, most every REIT, every major REIT has either prop tech investments, or they certainly have utilized different prop tech. It's really amazing to see the technology advancements that we've seen really over the last decade. So if you talk about it from the property sector level, think about it in 2008 and 9, we had data centers introduced, cell towers introduced. We've had more recently over the last few years, cannabis REITs. There's a growing number of cannabis players, both in the mortgage side as well as on the equity REIT side. We've had most every now imaginable, when I was in school, which is a long time ago, I'm not going to tell exactly when, but it was probably longer than many of you. When I thought about real estate, I thought about the primary food groups, maybe housing and retail, and then healthcare really wasn't really a major sector. Industrial wasn't really as big. And so now we've got all these different, property sectors, which creates a tremendous amount of liquidity. There's around $1.6 trillion of market capitalization just in the US equity REIT universe alone. So that creates a really nice opportunity for individual investors. And by the way, REITs were created for individual investors. That's average Joe and average Jane, not really for institutions. Of course, most of the assets are institutionally owned assets, but recognizing that's how REITs were formed for that reason. So this has really been a huge opportunity, really over the last decade, for these REITs to continue to grow and to scale, to use that cost of capital advantage, to generate those wide moats, which is scale and cost of capital. And so within the sectors, I'm actually looking at my screen right now. I know you all can't see it, but we cover all the sectors. We even created our own cannabis subsector. I know NAREIT utilizes different categories, but we actually have a cannabis sector, cell towers, malls, single family housing, manufactured housing. I could go on. And I really like the net lease space. Net lease space, which I used to be, I didn't say this in the bio, but before I became a writer, I spent a lot of time building freestanding buildings for companies like Advance Auto Parts or O'Reilly Auto Parts, Walgreens, CVS, Walmart, for example. And we're seeing a lot of demand in capital flowing into the net lease sector. And that now supports the gaming REIT sector, which is becoming a very massive sector. We saw a transaction last week between Realty Income, which is an extremely large landlord of net lease. In fact, the largest net lease landlord in the world in the public sector. They just announced last week an acquisition in gaming, which is their first. I thought that was really interesting. So again, I could go on, but there is so many different categories now. I think about this, and I say this a lot in my writing. When will we have NBA stadiums converted to REIT assets? When will we have when will we have basketball arenas? Six Flags, for example, Six Flags. When couldn't that be a sell leaseback and owned by a REIT and leased back to Six Flags? So there's all of these opportunities out there. The investable universe is large. As I said in my book, publicly listed REITs control roughly 10 to 12% of all institutionally held real estate in the US. Now, it doesn't include residential housing, but all of these big warehouses, apartment buildings, and shopping centers and so forth. So I think the opportunity set is there. You're going to continue to see the consolidation. These companies like Federal and Camden, again, are going to dominate. They're going to grow. I think we're going to see more M&A. We've seen over the last 12 months, even from COVID, when we started COVID with Simon and Taubman, they finally worked out their issue and got that one closed. But we've got a large number of M&A players that have already announced, that have already closed on the public side, as well as the public to private side. So I just think this sector is going to continue to grow and get larger and larger. And again, that's going to benefit the average investor who's looking for that one thing, again, that dividend income. And that's the most important part of that message. So happy to answer any questions. Hopefully I covered that.
Well, we're going to kick it out to questions to Elaine right now from the floor. I do think the Celtics at one point were a master limited partnership, so I think that is coming at some point. But those are great ideas.
I think that's a great idea, and I don't think my student here that's from the sports management group here at GW, she really wants to get into sports management. And I'm telling her, get involved with those stadiums, get involved, and here you go. Kind of combine her training between sports management, real estate, and Rodney's class. So maybe we'll get her to take your class in the fall, Rodney. So we're going to start out. Some people would like to ask their questions live, which I'm happy to have. So Alex, you want to ask your question?
Sure, we'll be happy to. Can you guys hear me?
Yep, we can hear you.
Thank you. I'm Alex Wayne. I work for CBRE, class of 18. Really appreciate this panel. I guess I have a question for Jeff. What was the hardest part of the pandemic, your centers, in terms of rent roll? How many percentage of tenants are paying rent at the worst of the pandemic? And how did you kind of work with your tenants to kind of go through that? And Lori as well, can you share some stories about, people not able to pay rent and how you were able to work with them and all that? Yeah, that's kind of my question right now. Thank you.
Sure.
Thank you, Alex.
Hey, so Alex, on the first part of your question, if you go to our website and you go under the investors and presentations tab, we have a bunch of disclosures on what went on during COVID for collectability and occupancy and things like that. And there's a bunch of numbers in there. You can get your question answered very easily. I don't know off the top of my head, and I don't want to misspeak. If you need some help with that, feel free to reach out to me directly, and I can walk you through it off the call. The second part of your question, though, I mean, look at COVID was exceptionally tough on a lot of our tenants, and also a lot of our employees that had to deal with those tenants. I mean, many people that are renting space in a shopping center, the business is their job. So when they're told by the government that they have to close their job down and live off of their savings, and oh, by the way, pay their employees, pay their insurance, pay their rent, and a bunch of other bills, you can might imagine that's a very, very stressful situation. So, and it's very stressful for our people that manage those properties, that maybe lease that tenant that space, or are in charge of collecting rent, having to work with those people through a period of time when no one was quite certain when things would turn around. So I would say it was difficult in a lot of respects, and would not gloss over at all the emotional difficulty for the people involved in that. Our philosophy, again, like I said earlier, was, we think COVID is going to be temporary. We think eventually there will be a vaccine and eventually things will get back to normal. And what we wanted to do is work with our tenants, particularly the sole proprietorships, mom and pops, not the big corporate tenants necessarily that are publicly traded with huge balance sheets and lines of credit, and make sure that they were able to make it through the pandemic. So we did a lot of things proactively in that regard, and worked out a lot of stuff with our tenants as long as they were being direct and open and honest with us. One of the kind of bigger programs we had with our restaurant tenants, because we think restaurants are very important to the type of property we own. They're, oftentimes the heart and soul of the community. And in some of our bigger mixed use projects, they actually act as the anchor. We went to those operators and, said, we're going to restructure your lease. We need you to pay at least what we have to pay to maintain the property, pay the insurance, and pay the taxes, and pay us that or the greater of a percentage of your sales for a certain period of time. And we'll help you get through this. And I mentioned it earlier too, we spent a lot of money to make sure that those tenants were able to set up outside in a way that was comfortable for their customers, rather than having, 10, 12, 15 restaurant operators at a property running around trying to secure tents, tables, and heaters, while they're suffering through this time. We did that for them. So I think we acted very well through the pandemic. I think we were very creative and entrepreneurial in how we got through that with our tenants. And those tenants that were equally committed, creative, and entrepreneurial actually did very well. In fact, we had more than a handful of tenants come back to us because they were doing so well with their outdoor dining and said, hey, we don't want to pay you a percentage of sales. We'd be paying you more than if we were paying under our lease. So put us back on our lease, please. So I think that worked in hindsight, and we're proud and happy about that. And when the restrictions were lifted and things could go back to normal, our properties were in good shape. Our businesses were in business, and we were in a much better position than had we handled things differently and been overly tough on those types of people.
And Alex, I would, kind of echo many of the same kind of philosophies, Camden, that you just heard from Jeff, that we took at Camden. And what we did is, with the beginning of the pandemic, those first few months, people were losing their jobs. A lot of them were people that worked in the restaurant business, and they were not able to pay their rents. And so, we were initially thinking this is only going to last maybe for a couple of months. So let's help our residents weather this storm. Camden stepped up and contributed $10.4 million to our residents to be able to pay their rent if they just asked us that we created a lottery initially and offered 5 million, and it was gone in 14 minutes. We were overwhelmed when we realized how many people were in need. So we did another, it was supposed to be 5 million, but when the people are coming in and they're asking for help and the heartbreaking stories, we ended up doing, 5.4 million. So a total of $10.4 million. And then what we realized is, we got to figure out something, and this is going to last for a while. We got to figure out something else. So we went to work on creating some very innovative programs, partnering with people in the business, figuring out there were groups out there that were doing micro loans for people, that we were like, how can we partner? How can you assist us to assist our residents with no interest loans or, no interest to low interest so that they can get a micro loan for 3 or 4 months and stay in their apartments. So we help facilitate those relationships, figured out how to make them work, how to manage through the communications. We then, quickly learned about these ERAP funds, which, is the emergency assistance that the government was offering up, but across every state, every market, it was so different, so complicated. People didn't understand it. So we literally took people within our organization and assigned them to each market to figure out these programs, help our residents apply, called every single person that had not paid their rent to make them aware of all these different options, literally applied on their behalf so that they could take advantage of these funds that were available. And so throughout the pandemic, those are the things that we have done. The last thing we ever want to do is evict anyone. And, there have been sound bites out there, and we've been there's some stories about, residents being kicked out on the streets, and that there's going to be this incredible tsunami of people being evicted. And we haven't seen it. Our goal is to keep our residents in their apartments as long as they're working with us, as long as they're communicating and telling us that they want to stay. We're going to make it work for them in any way possible. And we do have some retail in our buildings, and we did exactly the same thing. We want those spaces to be occupied. It's a good experience for our residents to have activated spaces and not have it sit there vacant. So we worked with all of our retail tenants, forgiving some of their leases, restructuring every single one of them, because they were all struggling during those times, and just doing what was right. Because and the bigger thing we did is, when this all started, is we froze all rent increases on our renewals for that entire first 3 to 4 months. We took some hits from some of the analysts on that, because not all of our peers did that. And we just felt like it was the right thing to do. Same with the 10.4 million. I mean, when you are a publicly traded company, you do have to, answer the questions on your earnings calls as to why you did some of the things you did. And we just believe that it was, we're in the long-term business. Very similar to Jeff. I mean, you've been around longer than Camden. We've been almost 30 years, and we plan to be around for the next 30. And the only way you can do that is to, and when you have a brand, and Camden does have his name branded. And so when your name is on the properties, you hope that when they leave one, that they're going to move to another. And the last thing you want to do is have people leaving with this negative feeling that they were kind of kicked out while they were down on their luck. Now that's, not to say that we can't, we have to pay our bills, and we have to pay our taxes and insurance and utilities. But, the good news is by being that helping hand, that connection for the residents during a really tough time that they were locked in their apartments and struggling with all kinds of other things. We were that kind heart, and it all kind of goes back to our why, which is improving people's lives one experience at a time. And this was a way for us to kind of look back and say, this was our finest hour. So, we do have still delinquent rent out there. And I got to tell you, the majority of that is really because of regulatory environment, eviction moratoriums that are out there, where in some cases, and it's really unfortunate, people are just not paying because they figured out how they can live rent free. And those people we have people in the DC area in California that haven't paid their rent since this all started, and they're quite capable of paying. So those are the unfortunate stories, but for the most part, it was a pretty heartwarming experience for our teams and the organization to be able to do what was right and help our residents.
Wow, Lori, that's really impressive. Both of you, both REITs, really impressive what you both did. We've got a question now from Michael. Michael, do you want to ask your question? And we have about 5 questions in the lineup. Michael? And if Michael had to leave, we'll go for Nicholas. Or I'll ask the question myself. Oh, there's Nicholas.
Oh, hello. There's more question for Mrs. Baker. just a personal question, more or less. When I heard you talking about there's been a big migration from urban to a suburban during this time, and I kind of had questions as to like where it would be a better place to live. Personally, I had a hard time finding an apartment here in DC, coming, off of the pandemic. I heard a lot about, there's renter shortages, there's not a lot of places to be. But at the same time, I was reading the news that a lot of millennials and the generation before us were going out of the way and buying houses now that they're like, I'm not sure if they were a lot cheaper, but they were going out of the way to buy houses in suburbs. So it just kind of seemed confusing to me that there'd be a shortage of rents, rental spaces when there's also a lot of people moving out of rental spaces into the suburbs. And, going hand in hand with that, would the cost of living and the prices in like the suburbs, for example, go up as a result of, a big population shift moving outward? And would it just be better to follow the migration, or like, would you anticipate that it'd be better to stay in the city, for example? Because personally, I plan on staying like in DC after school.
Well, I mean, anecdotally, I can just share with you that, the move out rates for home purchases remain low still. It's only like 16.4% versus the peak of 23% right before the financial crisis. I mean, that's pretty, and that's been kind of maintaining. I mean, it kind of popped up a little bit in the last 2 years, but what the challenge is, Nicholas, is that there's just, we cannot build enough housing right now. There is a shortage in housing across the board. And a lot of that is being driven by supply issues. You just can't, the real stories is even when we're building our apartments right now, we're struggling to get appliances. We're struggling to get contractors to do the work. There's just a labor shortage in construction. There's labor shortages everywhere. And that's kind of the choke point, is then getting the supply. And so even if we want to build more apartment homes, or people want to build more houses, there's a challenge in getting that done as quickly as we used to be able to. It's extending the time frame. So in the meantime, so everything, what we're seeing and we're hearing, and anecdotally, the stories, there's a lot of people bidding up pricing, even in the suburbs for homes. But what for you personally, if you want to be in the city, I think you're probably in pretty good shape, because most of ours, and I can only speak to our, Camden's properties, I've seen that the rents in our urban areas are less than in the suburban areas. But when you've got 98%, 97% occupancy, it is supply and demand, and that drives up the prices for even in the urban area. So you're not going to get a bargain basement price, but it's going to be potentially lower than what you're seeing as far as the rents in some of the other areas. So, I've been even telling my own son, this is your chance. If you want to go live in that nice new building, high rise in any of the cities. Austin is not one of those, though, because you can't find apartments because there's so much demand and job opportunities out there, but you maybe could find one in Houston, Texas.
Mm-hmm.
That's great, Lori.
Thank you
Okay,
so
so
much.
Michael is back on. He's got his mic back on. So Michael, you want to ask your question? Oh dear. Okay, well, Austin, why don't you ask the question and I'll go find Michael's question, and then I'll ask it for him. Austin?
Yeah, can you guys hear me?
Yep.
Yes.
Okay, perfect. So this is kind of a general question. I guess any of you guys can attack it, especially with like the pandemic changing a lot of the philosophical, kind of way of making money, or like managing funds because of the changes of the way business and all the cycles went. Have you guys focused a lot on offset funding and looking at trying to kind of like in creative financing, looking at alternative ways to not just reduce expenses, but turn those expenses into revenue generating machines, so that you guys can really manage and maintain steady levels?
You want to take that first, Jeff? Since I just talked.
I'm sorry, Austin. I don't think I understand the question.
Are you asking about what are we doing to create kind of efficiencies and lower our cost?
Yeah, I guess so. And if there's any like kind of like vertical integration was a big thing, is just taking, just traditional ways and rethinking and creating innovations, and trying to find funding mechanisms behind that, I guess, or alternative ways of reducing costs.
Yeah, I mean, we're always looking for more efficient ways from a cost perspective to operate our business, whether it's at the corporate level or, at the ground level with the properties. I mean, that's one of our jobs, is to steward our shareholders' money as best as we can and not waste money running properties. So that's something we're always looking at. In terms of funding it, though, I mean, I don't think that there's a better funding source than our publicly traded debt and equity. So no, not really. We're not looking at other creative ways to fund our expenses. We think the public markets are very efficient. We think our capital is very reasonably priced, and there's not likely an alternative out there that's cheaper or better for us. So I think and hope that answers your questions, but that's what we're doing.
Yeah, and I would second that on the funding sources. I will answer the question about how are we kind of looking to be more efficient, and a lot of it is what you heard earlier about investing in technology. We're investing in technologies that allow us to just be more efficient with our teams, more efficient with our marketing spend, improving the overall customer experience. But given that our wages are going up significantly and combating some of this inflation, the one way to continue to be strong is to look at those opportunities to be most efficient and rethinking, and we're reimagining how we even run our operation side of the business. And really the pandemic was a great accelerator for us. I mean, we have been working on some things for a while, like self-guided tours, instead of having always a person leading, your tour if you want to come look at an apartment community. And because of COVID, that was what we were forced to do overnight. And it was pretty simplistic and nothing fancy, but thank goodness for mobile phones and FaceTimes, and our, Camden has its own contact center where our own employees are 24/7. We could guide people through our buildings and let them look at our vacant units and rent an apartment pretty much all online because of the technologies we had in place. So we call it the great accelerator with COVID, because many of the things we did to survive have now become mainstream, and our customers are comfortable with those kind of things. So we just got to get better. But we're also rethinking, what is the ideal staffing now on our communities with so many of these advancements in technology.
Yeah, I'll add one other thing, I guess, because I think those are great answers. But the other thing I'll add, I mean, you've got both of you have the A-rated balance sheet, so unless we want to go A+, but A rating is pretty good on secured paper. Some of the things, though, using preferreds, a lot of REITs have preferreds. I think Federal's got a preferred issue, I think, outstanding, but a lot of the REITs have, preferred shares, give you that financial flexibility. And a lot of retail investors that's the attraction really for retail investors to have these preferred shares. The other thing I will say is, and I know Federal and Camden haven't gone outside of the US, but being able to access capital markets outside of the US, one of the companies we cover, and my largest position is a company called Realty Income, ticker symbol is O. And they've recently gone into Europe doing some sell leasebacks with a lot of some of the larger European like grocery chains, for example, and they're able to utilize lower cost of capital in Europe. It means to hedge, but also they utilize that and match fund it with their US, really they over equitize their US investments, and they utilize that lower cost of capital, sub 2%, for example, in Europe. So those are some examples, I think, how a lot of these REIT management teams utilize preferreds and maybe European exposure or international exposure to lower their overall cost of capital.
And I guess I would just add, when our stock price was at an all-time high of over $180, we were issuing stock to take advantage of the marketplace. That's why we have quite a bit of cash sitting on our balance sheet right now and ready to ready to put it to work when it makes the most sense.
Come over to Greenville, South Carolina, Lori. I don't think you have any.
We don't. We're close with Raleigh and Charlotte,
Yeah.
but we're not in Greenville.
Rodney, you're gonna go with the last question, right? And there is a
Yep.
couple questions in the chat room, but I'll send them to you guys after. But
Yeah,
Rodney,
so we
you're
just
right.
have 2 minutes left now. So this is the lightning round. You weren't ready for this, so sorry. But here we go. So we have 2 minutes to get everybody's answers in, and I'm trying to thread some of the things that have been mentioned already with the panel that's coming next for CREUA, which is around technology. Laura, you can kick this off. Jeff, and then Brad, you brought this up yourself. How are you thinking about technology from your business and how you're incorporating? Many people think real estate and they do not next think technology. And so, but that's changing and companies are being forced to change. How are you thinking about that? And what's the outlook from the management team's perspective? Lori, Jeff, Brad.
All right. Well, since I already mentioned some of the things we're doing with virtual leasing and smart access and AI, Brad touched on this. And one of the things we started realizing is we needed a kind of an extension of our leadership team to be out there canvassing best technologies for us to take advantage of, especially with so much pressure on ESG. And we've got the S down, we got the G down on the governance and our social, but we really need to get better and smarter with the E piece, being more efficient on the environment and climate issues. And so we've invested in a couple of tech funds. And one of those is Modern Ventures, which is helping us kind of vet all the different products that are out there. And it's not multifamily focused, it's everything, and bringing the best ideas to us. And the other one is Fifth Wall. And we invested in Fifth Wall, which is kind of the behemoth of prop tech funds. And you'll hear about it, I am sure, on some of your next panels. But we invested in one of their funds that's a climate focus. We're hoping that that will bring some things that will move the needle. And the one area that we're looking at is new ways of building our properties, because there's been no great new technologies in my career in this business for getting, there was a couple of companies that tried, but we're really hopeful the future will bring something to bear that could allow us to reduce our construction and development costs.
Thanks, Lori. Jeff, over to you.
Yeah, real quick, two things that we've been doing here. One, and fortunately, we had this going well before the pandemic hit, but converting a lot of our internal communication technologies so people really don't have to be in the office. I mean, the nature of our business for a very high percentage of our employees is, they need to be out of the office to do their jobs anyway. So being able to do everything from an iPad or an iPhone and not necessarily be tethered to the office, and, having things like Zoom as opposed to an old school teleconferencing system. We've invested in a lot of technology like that, Salesforce, other technology platforms to make it easier for people to do their jobs and more efficient for us to do things like process leases and tenant build outs and all of that kind of thing. The other thing that we've been developing for a while, and we started looking at this 7 or 8 years ago before it really got to be as popular as it is today, is using mobile data technology, Placer AI, Credit Intel, some of the other providers out there to better understand who's coming to our properties and why and where they're going when they're at our properties and after, and using that in our leasing and marketing materials. So that's been a big focus of ours as well.
Thanks, Jeff. And to close out the lightning round, Brad.
I'll be quick because I know there's a secret at the end, I think, here. So I'll be quick. So really, we look at allocating capital to the technology trifecta. And what I mean by that, think of the stool, 3 legs to the stool. We want to deploy capital to the cell towers, technology, data centers, technology, and warehousing or industrial, which is logistics technology. We call that the technology trifecta. The transaction is started with the cell phone. It goes to the data center, and then it comes to your house via the logistics center. All those are connected. And what we see, the common thread with those three property sectors is above average earnings growth. And remember, in an inflationary environment, especially, earnings growth means dividend growth, and dividend growth is really what we're looking for. Again, the safest dividend is the one that's just been raised.
Thanks.
That was-
Great place to stop. I'm going to say thank you to Lori Baker at Camden, Jeff Burkus at Federal, Brad Thomas, Wide Mode Research, Senior Analyst at iREIT, and author of the Intelligent REIT Investor. And now back over to you, Elaine.
Oh, fantastic. You guys were absolutely wonderful. As you can see, you had a lot of questions. I do have another one I'll send out to you, but we have our surprise, and our surprise is we have a book to raffle off, and it's not going to be a raffle. It's going to be Brad, pick a number out of thin air.
7.
7. 1, 2, 3, 4, 5, 6, 7. So Michael Rosenzweig, who didn't get to ask his question, but he's going to ask Jeff himself. You have won a book. You have won the iREIT. Brad has graciously given us a copy, so we will be shipping it out to you. And Brad, thank you very much. We appreciate that.
Yeah, hopefully his question will be answered in the book.
Yes, I hope so. And yes, just so you all know, this is the beginning of 3 panels that we'll be hosting every 4th Thursday. So the next one will be March 24th. And as Rodney pointed out, it will be on prop tech. So I'm excited that we'll be studying or looking at that. And then the last one will be on ESG, which is something that Lori had mentioned. So hopefully our panelists will come and join us. And then everybody else will come back and bring your friends. Again, this is an open Zoom room. There's room for 300 of you if you want to come in. So we'd love to have you. And again, thank you very much, Rodney, Lori, Brad, and Jeff for spending the hour and a half with us. We truly appreciate it, and it went really fast. I was fascinated. And again, I agree with Brad. These 2 companies are stellar, and I just might have to buy some stock. I'm not a
Please
big
do.
REIT lover, but
I may be,
So thank you.
I'm not maybe, I'm going to be looking at your company, Jeff.
I know. I'm like,
Likewise, Lori.
This was
and
fun.
Rodney, you get that class studying them both. So again, we do appreciate your time, and I agree with Rodney. GW looked really good tonight on this panel. So thank you again. Bye, everybody.
Thanks,
Have a good
everybody.
night. Be
Thanks,
safe.
Elaine.
Be
Thank
healthy.
you.
Thanks,
Good job,
Lori.
guys.
Thanks,
Thank you
Brad.
so much.
Bye bye, everybody.
So, hey,